Welcome everybody, appreciate you guys coming out here tonight. The turnout is actually much bigger than what we first anticipated. Normally we do this a lot more intimate in the boardrooms, about 20 people. But as you can see here, we're probably closer to 50 here today. So thank you everyone for coming out, especially on a nice summer day, especially when you could be watching fireworks instead. So today, I'm going to be facilitating the conversation. My name is David Wong. I'm one of the managing partners of Stonewall Family Office. And today we're all here to talk about tax-free real estate blueprint. And we have 4 amazing presenters here that you'll be hearing from today. So the goal of us being here today is to talk about the collaboration for exponential wealth creation. So we want to prove to you that with the right partners, 1 + 1 = 5. And I'll tell you why we use 5 at the end of the presentation. We're going to show you that synergy always beats solo. So if you can go to an individual advisor or if you can go to team advisors, we always believe that a synergy or a team advisor is always going to beat out a solo. We're going to show you how you can go from linear to exponential growth. And lastly, we can show you how we can help you create wealth that outpaces today's market. The agenda today, really quickly. Number 1, introductions. You're going to hear from each of our presenters really quickly, quick intro about themselves. And then we're going to go into the actual blueprint. So first, you're going to hear from Max, who's going to talk about establishing a tax-efficient structure. So talking more about the corporate structure side of things. And then you're going to hear from Carl about reducing and managing taxes. And then third, you're going to hear from Brian over there talking about how to gain access to flexible capital with the assets that Carl puts in place for you. And then lastly, you're going to hear from James from Lightwell Homes about earning high real estate investment returns. Okay. And then at the end of that, we're going to have a quick, but an open Q&A session. Throughout the presentation, we are open to you asking questions as well at the end of each presenter's segment. But if you have any kind of questions, you can hold on until the end. We encourage you to hold it on to the very end, because your question may be answered by the next person that speaks as well. So the first person I want to welcome up is Max. He's going to quickly introduce himself.
Plan to do intros and then everyone.
All right, I'll make this very fast. Everyone, I'm Max Wolinsky. I'm the managing partner from Cold Harbour Law. We are, as the name gives away, a law firm in Cold Harbour. We're not a creative ad agency, as the name gives away. I'm a business lawyer. I advise on M&A, real estate investments, structurings, and a fair bit of charitable giving. And we're a full-service law firm, essentially helping with every aspect of both personal planning and then also business growth and exit.
Hello everyone, I'm Carl and I've been in the industry over 20 years. I've worked with a lot of accountants and they've taught me a lot of things. So basically all those things that I've been taught by the accountants over the years, I incorporate that into the financial plans that I'm doing for people.
Good afternoon, everyone. Just gonna wait until my picture shows. So my name is Brian Kim. I'm from Equitable Bank. I do look after BC and Alberta market for insurance lending for Equitable Bank. And I do work with Carl, like advisors like Carl, in this insurance lending businesses. I do come with about 18 years of banking and insurance experience as well too. So I'll pass it on to James.
Got yours. I'm James Livingstone. Used to be a chartered accountant, CPA for 24 years. My focus was private equity. So I left public practice as a partner. I started buying operating companies. So I bought businesses all over North America and Europe. Left that 4 years ago, and I wanted something closer to home. I was always on an airplane, and I thought, well, what problem can I solve? We have a housing problem. I thought, well, let's see what we can do with this. So we built a partnership. There's 4 of us. Randy Chang, he'll speak briefly too. Jonathan Ames and Eric. And so we focus on multiplex development. We're the largest multiplex developer in the Lower Mainland. Primarily right now in Vancouver, but also Port Moody, and we'll be expanding to other municipalities as they add multiplex bylaws.
All right, the last person I want to introduce, unfortunately cannot be here today. His name's Hero, and the reason he's not here is because he's a fictional character. So Hero is the individual that we're gonna take on this journey today. That's gonna go through each one of our advisors. So Hero, just for some context, is an upstanding 45-year-old business owner in Vancouver, and his goal of coming to us today is to look for ways to reduce his taxes and generate high real estate investment returns. So this is gonna be Hero's journey. He's gonna start with talking to Max, to find ways to protect him from liability and to reduce his taxes through corporate structuring, number one. And then he's going to talk to Carl to add a tax-efficient asset that Hero can then leverage. And then he's going to go to Brian with that asset to leverage for real estate and to provide tax deductions to Hero. And then lastly, with the capital that he's then gained access to, he's going to talk to James to increase his real estate returns. And so, with that being said, I'm going to pass it on to Max to start his presentation.
Thanks so much, David. Let me make sure that I have this working. I think we're good. Okay, so I'm cognizant that no one ever wants to spend more time listening to or being with a lawyer than they need to. So I'm going to keep this relatively brief and then pass off to the more value accretive and more interesting and probably better looking presenters for the night. But I'm going to lay a little bit of foundation for essentially everything that follows after this. So basically what we're going to talk about is how to structure really it's your business, assuming that most folks here are essentially earning enough income to be investing and utilizing the strategies that are coming next. So just for some context, as a lawyer, most of what I do, I kind of take a lens of what we want to do is maximize the value that you're actually getting and minimize your risk as we do it. So to the extent that we can, how do we make sure that the revenues are as high as they are, or as high as they can be, that you're keeping as much of that as you can, and that we're protecting against as many kind of contingent or possible risks as we can. So what we're talking about today, or what I'll be giving a quick primer on, is essentially just that. How can we structure your corporate structure, or structure your kind of business affairs in a way that lets you maintain, even if it's kind of temporary in some sense, which we'll get to, as much as you can. So with that in mind, let's jump in. So what are we talking about? Really what the structuring that I'm going to be talking about for the next few minutes relates to is folks who have an operating business of any kind. So if you own a retail shop, you're even professional services, you have a team, you're a realtor, you're a doctor, you're a lawyer, you're selling widgets, doesn't really matter. If you have an operating business that essentially does commerce, so you're doing some kind of transaction with anyone, really, you're not just kind of investing in passive investments, then that entity, assuming you're set up in a company, we're going to call that an operating company. That company is exposed to risk. It can get sued, you can have a bad tax reassessment, you can have an angry spouse, you can go to the wrong Coldplay concert, whatever. There's always risk. We saw the joke, I'm going to turn this iPhone around at one random time tonight, and one of you guys are in trouble. I don't know who's here with my spouse. So you have this operating company, you're making good money, you know, let's say Hero's doing $500,000 a year with what is essentially take-home revenue, tax man's coming for that, and they say, give me my disproportionate share. One way that we can essentially grow revenue is deferring as much as possible of that tax, right? So we'll get into some actual figures or examples after this, but if you're essentially doing $500 a year in what could be take-home revenue pre-tax, if you're drawing all of that, you're taking it out of your company, you're going to be down in the $240 or so net range. If you leave that in a company, assuming you can qualify for the small business deduction, essentially the preferential tax rate, that number that you keep at the end of the year, that could be $440,000 or so. Obviously, most folks need some of that money to live on, so even if we cut that in half, the savings in keeping essentially your excess earnings in a company as opposed to paying it out personally and then paying tax on it and then investing the kind of post-tax money, it can be huge. And just to evidence that, or kind of give an example, I think if I offered anyone in the room a $100,000 loan interest-free every year for 20 years, everyone would take it, right? They'd say, okay, if I get 5% on this for every year that I have it, it's about $1.5 million over 20 years. You pay the principal back, you're still up $1.5 million. So it's that kind of time value of money that we're able to to really realize on when we have the kind of excess earnings in a company. But again, Coldplay concert, whatever, there's risk. So the question is, how do we actually get things set up so that your end of the year net profit, your net revenues that you don't need to draw to live on, and that are excess after you pay your staff, everything else, is safe. So in terms of growing the pie and then also protecting it, what that means is essentially having a holding company. So the holding company is going to be the kind of investment vehicle that actually owns your operating business. So we have Max the lawyer, we have Max's holding company, and we have Max's law firm / Coldplay Joe concert factory. Anything excess that is from your hat store, your law firm, whatever, it flows into the holding company. Whatever you need from there to live on, you pull. But whatever you don't, you leave in there, and that's essentially safe from any liability. So that holding company, we can think of it as only being really subject to risk from the top down. So if you're personally going bankrupt, your holding company's in trouble. But if your business is going bankrupt, your holding company is safe. So if you're moving in $200,000 a year from your operating business to your holding company, if your operating business fails, tax reassessment, etc., it's generally the money in your holdco is safe. So that's the real kind of the value add here in terms of a proper corporate structuring. So we're already hitting on this a little bit, but again, just to really drive this home, any money you pull out of a company, whether it's your operating company or holding company, at least once you're in that kind of top bracket, you're paying 52%. If you have an extra 100,000 of kind of net income you don't need, you pull it out personally, there's probably 45, 50,000 left for you to invest. You leave it in, there's 90,000 or so to invest because we're looking at an 11% corporate tax rate. So that compounds. This isn't essentially saving you from paying the tax ever, it's letting you defer it for 20 or 30 years until you need to pull that money out to live on, and then you're able to do it in a more kind of flat, tax advantageous manner. So again, really just leaving the money in a company for as long as you can while still protecting it against risk that operating companies face. That's really the goal here. In terms of a quick primer on why this works, the holding company can essentially invest in anything you want. It can be securities, it can be sitting there in cash and bonds, or in, as we'll get to, higher value, higher profit, higher essentially value accretive strategies like insurance policies, real estate development projects, funds, anything. There's no legal limitation really on investments you get into. And again, you essentially get to capitalize on that tax that you're deferring that you otherwise be paying the government in year one. So I'll end off with a couple just examples of the numbers we're talking about here. So if we're looking at someone who's making $500,000 a year from a business, or really any kind of income that we can capture in a company, if we're taking that all out of a company and essentially paying a personal tax rate on it, your kind of average tax rate on that is going to be somewhere in the 40% range. You might get aggressive on some deductions, you're still looking at somewhere around 40%. If you didn't need any of that to live on and you can leave it all in your holding company, you're getting about an 11% effective corporate tax rate. You have $445,000 to invest, and that compounds, right? So that almost $200,000, $160,000 spread, you can earn a return on that compounds every year, and again, you're taking advantage of that smaller tax rate. So that's the foundation in terms of how to keep as much money as you can in a company to actually get the time value of that money. And then, smarter guys tell you exactly what to do with it. So, with that said, Carl, I think you're up next.
Quick question,
Thanks, everyone.
Max. In your grid there, on the right-hand side, you had an acronym SOFO.
Stone Owl Family Office.
I was going to ramble for 5 minutes before I got that, so. Bless you, Carl.
I hesitated before I jumped in there. Yeah, so thank you very much, Max. That sets up the foundation for what we want to talk about perfectly. And really, I don't have that. Really, what we want to do is we want to preserve what Max has done as much as we can. So my next step really is to look at what Max has done with the tax advantages that he's been able to put in place and make sure that we're able to carry that through. Because we don't want it to stop at Max and all of a sudden I put in a bunch of investments that's going to mess up the situation. Maybe I put in a lot of passive investments that have a lot of tax, and as a result, maybe I lose the small business deduction. And now I'm in a situation where everything that Max has put in, I'm actually undoing that. So the important thing for us is really to kind of follow on Max and make sure that those tax advantages are going to continue through. So if we look at what we actually do, we put in life insurance policies with high cash values. So the great thing about the life insurance is that it's tax exempt growth and it's highly collateralizable. So what we get to do is we get to be the bridge between what Max has done and what Brian's going to be able to offer. And then as an added bonus, there's a tax-free benefit when the individual passes away. So we think about why this works, and again, getting back to the whole idea that we're going to use life insurance as a bridge. And that bridge is respecting the tax advantages that Max has put in place and providing a foundation that Brian can actually leverage against. So we're using all the money that Max had talked about just a little while ago, that spread, we're retaining that and we're leveraging it out. So if you look at other risk-free investments like a savings account, we're looking at about a 2.5% rate of return, whereas in the life insurance, we're looking at about 5%. And that's just some historical returns for you to see. And then when we look at the tax that you have to pay on the savings account, it's about 4 times more that you get with the life insurance than you're going to get with the savings account. And if we look at why that's important, there's a few different ideas here. Number one is that it's very highly collateralizable. So we look at liquidity, and life insurance has got it. We look at the returns being greater than the interest rate, and life insurance has got that. Stability and consistency, life insurance has got that also. We look at the tax exempt gains, life insurance has also got that, and it is also insured. So if you look at the bank account is not going to give you the returns that it's going to beat the interest rate. If you look at the real estate, it's not going to be liquid enough to properly borrow against it. And then if you look at the stocks, they're not actually going to be stable enough to borrow against it. So you can see from the insurance perspective, what it really is it's the most pristine capital that you could use to go to somebody like Brian and be able to start leveraging against it. And we're maintaining Max's structure. So another thing that is really effective and actually can help us with the lending also is that the life insurance death benefit when Hero passes away will pass to his family tax-free. So as a result of that, Hero will have the opportunity to borrow the money out personally and to use the death benefit to pay out the loan. So we've got a few different options. We can do corporate borrowing within the corporation, or Hero could potentially do some personal borrowing outside of the corporation as well and use the death benefit to pay out the loan. So I've dealt with a number of high net worth families, and a lot of these high net worth families, they recognize all the benefits that we've just kind of talked about, using life insurance for tax-free growth and having all the leveraging opportunities, but they have all the leveraging opportunities that they need. They don't have to put in the collateral assets necessarily to do that. So a lot of them actually say, hey, I don't care about all those tax strategies. I just want as much death benefit as I can get, because they want what's called the CDA. So that's the capital dividend account. That's the money that comes out of the corporation tax rate. So a lot of them will just be focused on that. They're focused on the next generation, the next generation, the next generation. And they really just want that capital to go through the future generations. So they'll say, yeah, that's what I want. If you can get me more, often they'll have up to the limit $240 million. And they'll say, if you can get me some more, then I'm happy to go along with it. So again, if we look at the numbers, what I wanted to do, I think this is an amazing outcome that we can end up only paying the 11%. So we want to retain that as much as possible. So if we look at, if you go it alone, you end up in 10 years with about $3 million. And if you use the SOFO solution, you end up with about $5,400,000. And you've got the estate also of the $16 million. So that's basically the advantage. But one thing that you'll notice is that we went down from $445,000 to $385,000. So that's what we want to solve for with Brian. When Brian comes in, he's going to be able to bring back that money that we've lost from the $445,000, so that we can have full access to all the capital that Max has been able to save for us. So basically what we've managed to do is reduce the tax and add the death benefit to really amplify Hero's returns. Cool. And then off to Brian.
Thank you. So as Carl mentioned, I don't think I have the ability to bring the death to the life again, but obviously my work towards the insurance and the planning is to bring the money that the client or the person who pays towards the premium back to his cash flow. So just to give you an overview, and even before I go over my presentation or my information around how I can actually explain that will work, just wanted to point out a couple things why the preservation of the assets earned within the holding company is important. At the same time, how he can help you to protect using the insurance policy is important as well, and why those two things are important. And then if there is no growth within the assets within the holding company, then there's no really a point of preservation and the protection, because the whole idea is to not only just preserve, but at the same time you want to grow the money that is in there, right? And then pass down to your heirs. So I wanted to bring out a question to you. Have you guys heard about what immediate financing arrangement is? Has anyone heard what IFA? Yeah. Good, Chloe, thanks. It's a good opportunity for me to introduce what IFA, immediate financing arrangement, is. Okay, so as it says, advancing an immediate financing arrangement is the strategy that can be utilized to bring the money back to the cash flow of the individual or the corporation. And at the same time, by doing so, there's a ways to minimize or have tax deductibility in terms of the interest cost. So how this immediate financing arrangement would work is basically, as a client or customer of the policy, they purchase the policy to protect their hard-earned money within the holding company, right? And what they do is they pay the premium. And once the premium is paid, they just use their money, right, in order to get the coverage. What we do as a lending institution, we assign the policy of that individual and we lend the premium that the client paid right away. And how we can do that is need to explain a little more about the specific policy that we're talking about is a life policy. We're looking at whole life participating policy, which does have the investment savings within it. So within the whole life policy, there is a investment structure within where the money will grow over the time. Not only that benefit part of it, and the lenders like us are interested in that cash surrender value because it only grows, it will not depreciate over the time. So that's why it's a very secured collateral that we can lend against, and that's why we can actually do this strategy for the client. Okay. So what happens year after? So let's say a client is continuously paying the regular annual premium over to continue to have the coverage of their life insurance. They pay, let's say it's $100,000 a year. They pay $100,000 a year every year out of their holding company. Without the IFA strategy, they are just injecting money into the whole life policy, and they lose the opportunity cost of using that money for something else, other real estate investment or investment, something that they think about investing into. So what we do is obviously subject to our review and the guidelines. We do lend the subsequent premiums back to the client. So let's say a client pays $100,000, and based on the overall, we confirm, we assign, we hand that $100,000 back to the client. So now the client does have the same money, but at the same time, client does have the insurance coverage, and the money within the insurance will continue to grow exponentially. So we're helping the clients to have the access to the cash flow that they already had instead of jeopardizing just putting the money into the insurance. And at the end of the life cycle, everyone needs to go somewhere, right? If that happens, what will happen with the loan that we're lending out to the client? Client's policy will pay out the loan, and any remaining will be given to the heir beneficiary. So when we do the assessment for the lending application, we definitely wish to see the whole projected growth of the insurance. Make sure that we have enough coverage for our loan over whether it's 5 years, 10 years, 20 years, so that there is always a money left for the client. And it is certain, the same as any other loans out there, and there's no restrictions whether the client wish to pay the loan back at any point in time with no penalties. It's totally up to the client how they use the funds that they regain back from the lending, whether they can invest into real estate investment or into the business to grow. So once again, just the focus here for IFA that works with insurance is that IFA is to have a full access to the 100% of the premium that the client paid, which means they're gaining back the cash flow, gaining back the ability to use that funds for other purpose that will grow even further of their investment or their assets net worth. So this will really help structuring the retirement planning and obviously recoup more value from the borrowers as a whole life. So you're not only now having a coverage from the whole life and the cash surrender value growth within it, as I mentioned, there is the opportunity cost that the client can actually use that funds that they borrowed, again, as tax-free, into something more lucrative for them, right? Let's say, once again, real estate, something that they wish, because you always hear about the diversifying your investment, right? So you're not only investing into the whole life, at the same time you have that money to invest something else. You're, I wouldn't say double dipping it, but then you have the opportunity to do so. And also, as I mentioned, depending on how you use your borrowed funds, it's tax-free because it's borrowed funds. Depending on your following through the CRA guidelines, the interest cost of the borrowed funds can be tax deductible. So it could be a very tax efficient way of investing into whole life and then leveraging this IFA solution for them. Another thing, the main thing is the liquidity of the assets. At the same time, the cash flow, preservation of the cash flow of the client. Because in majority of cases, when I talk to the advisors or the client itself, when we introduce the insurance policy, sizable premium, their concern is, even though I have money now, I have funds in my account, retained earning as, it's just that what if I need the money back, right? Once I start putting the premium back into the policy, what if? if I need that money. So there's a little bit of hesitation, and this IFA structure, the strategy itself that we've in place, will definitely give that flexibility and the liquidity back to the client. So there's no concern from the business owner's aspect where, oh, I need this money to invest back into the business, or I need to buy equipment, I need to invest it into another commercial building that they need to, right? So once again, the borrowing against the year's life insurance investment, loan is the perfect way to provide liquidity. That's the main thing. At the same time, you're now opening up the opportunity to invest into something else while you're maintaining your cash flow, maintaining your life insurance coverage within your holding company. And as I mentioned, when used based on the CRA interest rate deduction guidelines, this interest from that loan can be tax deductible. And key insight on this slide is showing the bank loan. So I'm assuming that our interest would be about 4.95, where the life insurance will pay about 5%, the rate of return within the cash surrender value within it. So the cash surrender value will grow over 5%. And there's a tax rebate, which would be tax deductibility. The actual rate on the interest rate is 2.44. So the difference between those two is 2.5 spread. So which means that can be a much lower interest spread. At the same time, as I mentioned, we're not only looking at the interest cost of the borrowed funds, but think about the opportunity that you can earn more on the cash flow that you receive back into something else that you can earn much more than 5-10% will make up the spread here. So that's something to think about as well too. Lastly, as Carl mentioned, I'm going to explain why there's a difference, and then with the strategy of the IFA, you're actually gaining the full access to the funds. As I mentioned, we're helping you to gain that cash flow back, even though you're now investing your money into the whole life insurance. So without obviously having the IFA solution, you still have the good strategy where the life insurance will cover your business and your needs and preservation and the protection of your business. But at the same time, if you incorporate this IFA into your business and the insurance strategy, you're actually having the same accessibility now, which you can utilize for something else too. Okay. So I'm moving on to how you can actually use that money to invest into something more meaningful.
So our number one focus at Lightwell, when we look at problems investors have in Canada today, is how to get ahead. I mean, look at our situation in Canada. Any income over $250,000 held personally is taxed at 53.5%. It's absolutely terrible. So what Max was talking about with the CCPC, Canadian Controlled Private Corp, it was intentionally created by the government to help people without pension plans defer tax and compound. And so anybody can take advantage of that. But what you invest in that company is really important. So there's something called passive investment, passive income. That would be rental income, interest income, dividends. That's taxed at 50%. So often I see people investing in the wrong things in companies. In real estate development, with what we do in particular, it's active business income. So it's treated the same way as any business income. But it's kind of unique in that it's a passive investment that you get active rate. So that's that 11% rate they showed, plus after that is 27%. But ultimately, investing today is tricky. We've just watched in the United States, as an example, commercial real estate like offices, safe investment for 100 years get blown up. Like massive losses, 80% decline in values of buildings that 5 years ago were 300 million and they sell for 60 today. We've seen, and that's just from a social change. So the one, philosophy that I'm using now to manage risk is short duration. I used to buy companies in private equity. I'd buy a manufacturing company, say in Ontario, and we'd grow earnings. But look what's happened in the last 5 years. Pandemic, inflation, tariffs, it's tough. And it's that long duration. So I was looking for an investment that had short duration features. And actually I was looking initially at duplexes. This is before multiplex. But I needed a team. I'm not a builder. My background, accounting, finance, I can grow businesses. I have a lot of business experience, but I'm not a construction expert. So that's where my partner, Randy Chang, he brings that to the table. My partner, Jonathan Ames, he does land acquisition. He's been doing assembly for 10 years. So we built this group. And really what we were looking at is, how do we solve the housing problem in Vancouver? And which begs the question, what is the problem? And what we're seeing in Vancouver in particular is that 25% of our population over 65, they have big homes. Where are they going to move to? They're achy knees, backs. As you age, they become more fragile, so they don't want stairs, and they don't want to live in towers. So there's no real solution for them. So we're building one-level homes now, as well as 2 levels with elevators. So that's one solution. The other solution, let's go to the people, that's the downsizers, with families. And families today is more than just people with kids. I'm seeing a lot of couples with dogs. They have 2 dogs, live in Olympic Village, Yaletown, downtown, but where do they want to move? They want to move somewhere more residential, but they're looking at, let's go back here, they have a choice. So this is the first choice, are half duplexes. So detached homes, brand new, are going to be about 4.2 million and up, very expensive. The next option after that on the west side are duplexes, and we can see here the pricing. You can get a $2.2 million half duplex, but it's 1,291 square feet. And you can see it as developers, we're always fixated on price per foot of what something sells for. And what we see here is 1447, 1584, 1742. It's pretty high. With multiplex, we're anywhere from 1250 to at most 1400. So it's less costly. And this is what your third floor of a half duplex looks like. So you're spending $1,500 a foot for a dollhouse. And the reason that it's funny with all the ceilings is because it's free. It's free space. So the rules in Vancouver, if your average ceiling height is less than 7.4 feet, this doesn't go against your FSR, floor space ratio. With multiplex, we're huge. We're 37.7 feet high. So often our main floors are 10 feet high, and then 9 feet, full boxes on the second and third. The trouble with what we're doing is no one's seen them. So we're just finishing our first one. My partner Randy has a project that's finishing in 2 weeks. So people can finally go in and see what they look like. The other solution are townhomes. The average, I was looking at a Ready report for Q1 of this year. The average townhome was selling for $1,438 a foot. So again, much more than we're selling for multiplexes. And look how wide they are, like little bowling alleys. So 13 to 17 feet wide, we're 20 to 30 feet wide, and sometimes even wider. So what really has happened in Vancouver, and I was born here, moved to Campbell River as a kid, came back, went to UBC, and so when I left UBC, I was trying to save money, so I lived in a basement suite, and then I had a roommate in a 2-bedroom downtown, and gradually I moved up, and I was lucky to buy a house. But in this case, it's people are compromising on their living conditions. Townhomes don't sell as well anymore because people realize just how small they are. Our homes are much bigger. And really what's happened with multiplex in general is you're giving up garages and underground garages for pad parking. And you're exchanging that for larger living space. Because with what we do, we don't have an underground garage like a townhome, and we don't have a enclosed garage like you would have a duplex or a detached home. But we have one parking spot per unit primary. We have, I think, a couple where that's not the case, but most of them will have one park as well. In terms of some of our projects, we have 16 of them. As I mentioned, we're adding more. On lot sizes, the bulk of them are between 6,000 square feet and 10. A lot of 8,000 square foot. We're not buying under 6 anymore. It's all 6 and above, but we have a couple that are smaller. Our first project will be finished in December. To talk about our project, I'm going to bring Randy up. Where's Randy? There he is. So Randy is the person, I thought he has more credibility. So, but he does, he has a team of people who works with the builders and they build these. So here, Randy, you can describe that, you can take this over, and you can describe what you're building here.
So this is one of our first projects. It's over at 950 West 57th, which is between Canby and Oak, near Churchill High School and Sir Wilfrid Laurier Elementary. Great neighborhood. So we got 5 units on this lot. It's about an 8,500 square foot lot. In terms of configuration of choice, what James was talking about earlier is we have different configurations that typically you wouldn't see in a multifamily development. Like if it was a townhouse development, everyone's going to try to squeeze in as many units as they can to be able to maximize efficiency. And then typically what that means, it's either they're narrow, long, and tall, and then that gives you multiple stairs, and configurations aren't as roomy as they feel. So what we have here, that front unit, the one that's in white, it's 1,550 square feet, all on one level. So it's 3 bedrooms, 2.5 bath, 9-10 foot ceilings depending on the unit. And now you get full expansive space, which definitely is something that is not currently available on the west side. You wouldn't be able to find this in a condo or a townhouse. It just developers won't build it. The other units, what we have is other choices. We have 2 units that are stacked on top. They're about 1,700 square foot each on 2 levels. And then each unit there has a 750 square foot private terrace, which is very, very nice. And typically when you get a rooftop deck or some sort of open patio space, it's typically very small, or like on the townhouse, it's on the 3rd or 4th level. You're going up 3 levels of stairs, and you got to carry all your food up there. And, Vancouver people don't really use their decks too often. But in this configuration, it's right off the living space and right off the kitchen, so it gives you that sense of home and feel. That's part of the design that we want to make sure that we know in this neighborhood, families, they want the school district, they want to be in that neighborhood. Traditionally, you couldn't afford it for the price point that we're delivering at. This would have been a $4 million lot, then you would have spent $3 million building something. All of a sudden, $7 million, and then the majority of us are priced out, or local buyers may not have the funds. And now you're sitting at a price point that is somewhat attainable in that $2 million, give or take. Perfect. Clicked it on. So
Yeah.
this is another one that we have, which is 2 doors down from that other project that you just saw. We're just about to break ground on this one. This is 6 units. So what we've done now is, instead of doing that stacked townhouse configuration, the beauty about multiplex is that there's a lot of flexibility in terms of how it can be designed. So what we have here is we have 2 duplexes in the front, which would be your total of 4 units, and then we have 2 laneway homes in the back. These are about 1,550 in the front and about 1,100 in the back. So now someone coming into that neighborhood, you can buy a fully detached home on that west side, 1,100 square feet for under 1.5 million, which is not available. You talked about numbers?
Yeah. We're about to have 8 under construction. So we're getting permits. We've gone full cycle on 8 projects with permits, so we know how to get permits now. This is typical of what we offer investors. It's a limited partnership. Some of you may have already invested in LPs. And we develop 2 properties in each limited partnership. So this is Lightwell 3. It closes end of August. We have 2 properties, one at 481 West 17th. That's Canby Village. I was really surprised to find out. My partner Jonathan kept on saying, "Oh, Canby, we got to buy something in Canby." And I always remembered Canby Village is, it's nice, but it wasn't, one of the top neighborhoods. Now it's probably the third most expensive neighborhood in the city. Be like Kitts, Point Grey, and then Cambie Village, because it's close to downtown, very quiet neighborhood, nice feeling streets, close to SkyTrain, and lots of restaurants. So a lot of buyers prioritize amenities, so all the restaurants and coffee shops in Cambie and Maine. So if you want to buy a house here on a good size lot, it'd be $4 million. It'd be the same as, say, Dunbar or Kerrisdale or Mackenzie Heights. So you can see we have our net sales price, our cost, and profit. So the combined profit of the two projects is $3.2 million, and we have 11 units, 5 in the first one and 6 in the second. In terms of terms, in this case, we're raising $4.3 million. The GP contributes 10%, and we have 7 of these. So our contribution adds up throughout all our funds. Minimum subscription is $250,000. We have taken less because sometimes people don't have all the liquidity at a given moment in time. The general partner is Randy, Jonathan, and the fourth partner named Eric Wong. And so we guarantee all the debt. So it's typically 75% debt, 25% equity. And you can see the LP is called Lightwell Developments 3. It's a 30-70 split between the LP and the GP. In terms of fees, most of the fees are fairly standard. Randy, as an example, works in project management, so he just charges the standard PM fee in the industry. And in any fund, they're typically a 2% management fee on equity that we charge, up to a maximum of 2 years, so 4%. The main risk in this in returns for us, average about 50% return on equity. It's quite high, and the reason for that, I think it's because it's new, but also Randy's very strong at building beautiful homes and keeping costs. We have a number of investors who just didn't believe us. So on the west side, it might sound high if you're in Surrey, but on the west side, we're at $300 a foot for our costs. That would be the material and labor. And a lot of other groups are at $400. So we keep on getting pushback. And the reason being is a lot of the other builders are custom home builders. And in custom homes, that whole industry is about delivering someone's dream home, whereas we're developers. We're focused on economics. So Randy's figured out ways to deliver the look at a lower cost. We're not putting $3,000 toilets into our homes. But the main risk in this really isn't the execution. It's not getting permits. There's no zoning for this. That's where a lot of Vancouver projects have suffered. You've probably all heard the stories of 8-year zoning timelines for condos. For us, after an application, it takes about 9 months to get our permits. Randy knows how to build. He's just finishing his first project. His first home was before a Lightwell, but it was 3 homes, and he's built it in 7.5 months. So that'll go on the market shortly. So the main risk is selling them, because when we're building our performance, we're focused on today's price, and then we discount. So if let's say a half duplex is selling for $1,500, well, we'd be using $1,300 for our costs. So below both the townhome and half duplex. And we have quite a bit of contingency in our budgets as well to make sure that if prices do decline, we can still deliver a strong return. But generally, what I like about this is duration is short. Our investors say in Lightwell 3, that'll be a 16-month hold with a 50% return on equity. And it's active business income. So not only are you maximizing return on the upside, but you're also minimizing tax. And so we have something called a wealth builder schedule that if any of you are interested, I can send it to you. And it's just showing what happens to money if you just invest and reinvest every couple of years. Stocks, you'd be at about 2 times your money over 14 years. At a 20% return, doing what we do, it'd be about 6 times after tax. And if we could hit 30% every year for 14 years, as an average, we'd be at 13 times money. So the magic is that compounding, minimize your tax, and try to maximize your return from a risk-adjusted perspective. So even though we have high returns, we do everything we can. We're always afraid, right? We're always worrying. As I say, we've pretty much mitigated every risk, and the uncertainty, we've just added a lot more costs to our budgets. In some cases, up to $500,000. So if we can't sell them for quite as much, we'll still hit our targets. So that's what we're doing at Lightwell. I think we're back to David.
Yeah.
Thank you, sir. Maybe one of the smarter guys want to go through this.
Is that me?
Yeah, that's you, because you're the one who caused the problem here.
Yeah.
Brian came and fixed your problem.
Yeah.
And now you're going to show why it still makes sense for us to have you on the team.
Oh, perfect. hopefully I can stay. So if we look here, we look at the same kind of situation. If you were to do this alone, what would you end up with? So again, you would have started with that $283,000 because Max didn't really help you straighten everything out and make sure that you're structured properly. In 10 years, you end up with about $4 million, and the estate in 10 years is $3.7 million. Now, we've managed to go through Max's rejigging of your structure to make sure that everything's efficient. We've managed to bridge the gap here between Max and Brian by providing the insurance solution, increasing the estate, and also giving you that tax-free 5% rate of return. And at the very end, James has come in with, and Randy also, with their powerful investment and really kind of augmented those returns through two things again. So you'll see a theme here. We're always focused on how do we increase the return and reduce the tax. One without the other doesn't really work that well. We've kind of got to use both in combination. So here we see that James has brought in the power, Randy also, and that 30% rate of return, and I only did it every 2 years. There's a lot of potential that you could reduce that time frame. So I used the 30% rate of return, and I also used the active business rate for this to show what it would grow to as a result of that. So essentially the story here in the numbers is that in using different professionals and when they collaborate, we can really increase the return because everybody brings something a little bit different. And if you would have seen James on his own, you probably would have got some pretty good returns on your investments, and you probably would have had a pretty good tax treatment. If you'd seen me on my own, I would have been able to give you tax-free growth on your money, and that tax-free growth would have been at a pretty good rate over time. But when you start putting everybody together, you're able to really augment those numbers and really increase those returns. Again, through two things, through just absolutely increasing the returns and really cranking down the tax. Because the tax is really where you're going to lose most of your money.
I'll go back. So just to drive the point home one last time before we go into Q&A, in the context of real estate, so we're going to build a home together here, we're going to see that Max came in first to help Hero lay the foundation for the home he's about to build. And then once the foundation's laid, Carl comes in, sets up the framing of the house. Brian comes in, electrical, piping, and then finally James comes in and finishes off with the roofing and everything else. Makes it look all pretty. So when I said earlier 1 + 1 = 5, this is what I mean. 1 + 1 = well, there's the 5 of them there. And also, you missed this one, Carl.
Yeah, I didn't. Yeah, so essentially, is it one? No,
All right, it was supposed to be a joke, but he forgot the joke, so we won't worry about it anymore. Anyways, 1 + 1 = 5. Here we are. I want to be mindful of everyone's time. I want to jump into questions right away because we are at 8 o'clock, and we were supposed to finish at 8:30. Obviously, everyone's welcome to stay much later, but I want to take this time now to answer any question that people have.
It's just I was wondering if this presentation would be available for us to view later on somewhere on a link or something.
Yeah, so maybe I'll keep the mic.
This recording will be uploaded tomorrow about 6 o'clock on YouTube. Everybody will receive a link to the recording as well as the presentation. Cool.
So thank you for that presentation. Really well done in terms of bringing it all together. My question is, what are some common IFA triggers that we should kind of look out for as business owners in terms of, we're considering it and incorporating and all this stuff? What are some common triggers that I would need to look out for to know, like, okay, now it's time to figure out the IFAs and then also the life insurance coverage?
So I guess by triggers you would mean like kind of red flags, things that you want to keep in mind when you're considering something like that? Yeah, so one thing that's very important for an IFA, and when you're putting the policy in place, this is particularly important. Generally, it used to be years and years ago that somebody had $1 million, we could just plop that $1 million immediately into the policy. In 2017, there were a lot of changes made to the way that we could work with these policies. Essentially, CRA has an agreement with the insurance companies about how we're going to treat this as insurance, because the insurance companies more or less have the privilege of being able to have tax-exempt policies. So what they did in 2017 is they revamped the way that we could put money in. So now really, like the shortest period we can get money in is about 4 years. Usually it's 6 and above. So what we want to do is we want to make sure that the business has a lot of stability, because we want to make sure that we can look forward to potentially 6 or more years, and that we're going to be able to service that policy. When we look at Brian coming in with the loan, there is some potential that we could put the money in the policy, and we've got the liquidity because Brian was able to come out with the loan again, but we really don't want to rely on that. So that's one kind of red flag or checkbox that you really want to make sure that there's a lot of stability in the business before embarking on something like this. Stability or liquidity. Yeah. So I guess the second part that Brian might speak to a little bit is we want to make sure that you can get the loan year after year after year. Because if you're going to be putting this money in and you're promised this liquidity, we want to make sure that we can deliver that. So maybe you could talk to that a little bit, Brian?
Yeah, so good point that you're making, because at the end, it is a loan, right? Like you have to qualify annual basis every time you make the premium. So my usual recommendation or advice to even the advisors and working with the client is to make sure that we don't overextend the client's capacity when it comes to the cash flow. So when we see the cash flow of, let's say, 100,000, we don't try to oversell it to 150,000, because knowing that it will be reimbursed back to the client, right? So we make sure that we're intact with the actual planning and make sure the client does have the capacity of making that consistent premium payment year over year, even if there is one gap year where we can finance it, right? So make sure that the continuation of the cash flow, even without the actual approval of the loan, that the client can make the payment year over year. So that's the main thing. I don't want to say let's look at things conservatively, but obviously the whole idea is to, make sure that you have that flexibility at the same time, make sure that you're continuing to invest into the whole life insurance. So hopefully that kind of explains.
Yeah, I think that's helpful.
Yeah, no, I think that's really helpful. I think the one point that I'd like a little more clarity on, if possible, and I know it's going to be highly contingent on the individuals, corporation, but as the corporation evolves and you start to make more and you start to structure it differently, I mean, the structure evolves, right, inevitably over time. And with growth, how is that taken into consideration when determining what that, what the loan or the premium, will be ultimately? And how do you make sure that as the business owner, that's being maximized?
Yeah, sure. So when we assess the loan, I would say when we underwrite the loan, we certainly look at the potential of the business going forward, but we do base our underwriting on the book, right? The current situation. Obviously, there is the potential of the growth of the business for sure for over the year period of time, and obviously the whole plan is for the future, right? But I've seen a case where we start with a certain amount for the IFA with the policy premium, and then after about 3 to 4 years, and there's more money and then more net worth within the business, and then the business owner will need to cover for estate planning or succession planning. Then advisor comes in and then reassess the whole case, and then we're adding additional 50,000, 100,000 on top of what was originally in place of the policy. So yes, we only look at the current or the past history of the business, make sure that everything is within the box, that we're not going over and beyond to risk things. So if I answer your question, there is a potential of the reassessment of the business and the needs of the insurance and IFA in the future, but at the current moment, we're looking at just current financials of the business.
So you guys can hold on to the mic for the presenters. I'm going to bring this one for the questions. Thank you, Justin.
Question for Brian. What kind of interest rates will you be charging on lending against the policy?
So if we're just looking at the IFA, obviously lenders do have a different rate types or the structure of the IFA. We normally see from our end prime linked. So we do, especially for us, we put our rates under the prime linked rates. So you'll typically see around prime to prime plus 0.5% or 1%, depending on the case or illustration or the structure of the policy. We sometimes do also see prime minus. So I would say it's something around home equity line of credit is something secured against. Normally the banks do offer prime to prime 0.5, right? So you'd be looking at the similar range of the rates available.
Any other questions? Yep.
Yeah. With the existing business, if the owners already have whole life insurance, is there any way to convert that into IFA, or is it a brand new policy that needs to establish from the company?
How about it depends? Yeah, so there are different whole life plans and they are structured differently. So if you do have a whole life plan already in place in the business, then essentially what we do is we just assess that and see whether it does make sense for leveraging or not. And always the key is the cash value and the projected growth rate of the policy.
What if it's not in the business, it's on the owner itself?
So if it's not in the business and it's on the owner itself, what we would do again, we would assess the policy to see whether if it's very old, if it's been in place for a long time, it's a mature policy. In most cases, it probably doesn't make sense to put it up into the corporation, but if it's a new company, what we would consider is transferring that policy into the corporation and using it corporately. But there are ways that we can use the personal policy for an IFA also. So there may be some additional advantages to you potentially either doing it personally because you've already paid up the policy to a certain extent, or maybe there's even some combination where you could do it corporately and personally at the same time.
Thank you.
Thank you. So my question is, what is the kind of the floor, the starting point to start building structure? Is it the illustrated $500,000, or could you start at a smaller amount?
Yeah, you can definitely start at a smaller amount. Generally, we'd like to see probably a net income of $200,000 to start looking at something like this.
Thank you.
Is that the same with you guys? So you were talking about just doing the corporate structure alone, or doing the whole strategy, or which part?
Yeah, I think the corporate structure is the first bit, and then what are kind of the thresholds start considering doing the rest.
Okay.
But yeah.
Yeah, maybe there.
Yeah, I can touch on that a little bit. So I think the 200 number is about right. I mean, the variables would be what you spend, right? So 200 and you're spending 220, there's no point. 150, you're spending zero because you're dual income and you live on the core, it can be worthwhile. But I think generally, if you're, in my mind, you're saving even, you have 50 to 100 that you're not necessarily needing to draw pre-tax. It can be worth it once you factor in the kind of compliance costs and everything else. Carl, does that track with your sense?
Yeah, that definitely tracks. So when I was saying the $200,000, really that was more a net income number. So yeah, before a lot of expenses. For Max, I think you could get started before that, but when you start getting into the IFA territory, then you probably want a bit more than that.
We work with accredited investors, and the test is gross income of 200,000, or household income of 300, or net financial assets of $1 million, or just total assets of 5. So that 200,000 gross for us is a starting point.
Sorry, I just want to clarify. The operating company and the holding company structure. So that means that if I have a business, operating business, I need to open up another holding company in order to set up the structure. Is that correct? And then what would be the cost to set up that and per year annually for the extra cost of doing that?
Great, thank you. You're probably the best.
So that's a great question. In terms of cost for doing it, it's a little bit cheaper and easier the earlier you do it. So if you're setting up a new business and high conviction, it's going to go well, it's going to be a little bit easier to set up a holding company at that time, but it's never too late. Basically, if you already have a business, you have you have a restaurant, and it's doing well, we can basically just slide a holding company in. There's a little bit of compliance cost there in the setup. Basically, we work with your accountant to do some filings that make that whole process tax deferred. So in terms of time, cost, process, think of it as probably, it's not actually that much, $1,500, $2,000 on the legal side for setting up the structure with holding company, even if you're already incorporated for your business. And then somewhere around the same for your accounting on the setup side. Ongoing costs, annual legal costs, like $500 kind of thing, just for your legal maintenance.
Because you have an extra holding co, you will have to do also a tax return for the holding co.
Yeah, exactly. And then the annual accounting cost, it's going to be variable. I mean,
depending
on 1,000 to 5 to.
And you were saying that the setup, so if you have retained earning from the operating co, you can just transfer that to the holding co tax free.
Yeah, that's a great question, and I actually didn't touch on that much when I was chatting before, so good time to cover it now. Basically, as long as your operating company is an active business and kind of meets the other requirements for that small business deduction, you're going to get the 11% rate. You can move that typically, or almost always at least, on a tax-free basis into your holding company. So those intercompany dividends are typically tax-free, which is essentially part of the benefit of having a holding company. It's protected from the liability of the operating company, but it still has that tax benefit of being corporately taxed and not personally taxed.
Thank you.
Does this work for people who have money but they don't have income?
That's a really good question.
Could we just clarify which part of it that you're asking about specifically? Setting up the companies or the IFA or James's real estate?
Let's say we have a holding company. So for the IFA, actually for both.
Yeah,
No, I think that's a Carl question.
Okay. So yeah, I can speak on that directly. So you can do it if you have a holding company. The key is that this is a tax strategy. So what we want to see is some kind of tax issue that we can solve. So if you have a number of investments within that holding company, potentially you're going to be subject to the passive income tax rate, which is 50.67% in BC. If that's the case, then there probably is a tax problem to solve, so an IFA would make sense. If you don't have that tax problem to solve, then the IFA doesn't make as much sense, because essentially it's a tax strategy, right? So yeah, any holdco with assets in it, generally speaking, is probably going to be a better case for an IFA than even an active business.
And the IFA loan, I expect it's an interest-only loan. Right?
Exactly.
Yeah.
Monthly basis.
Can I just add on to that question? How much do you guys take into consideration worldwide income as part of this strategy?
Max might be a good person for that too, but it would depend on how much of that worldwide income is taxable. Again, we really want to focus on the fact that we're kind of solving some kind of tax problem for you.
I actually know about that.
Any other questions?
Are there limitations to the amount you can invest? The amount that you can
In
put
the
into
insurance?
Yeah.
So premium, limitations to the insurance premium.
You mean on the upper limit?
Well, even on an annualized basis.
Yeah,
as well.
so in Canada, you're restricted to about $240 million as the upper limit of the face value of the insurance policy. So we're pretty well stuck at that limit. After that, we can go to
But you can
Bermuda.
contribute annually.
Yeah, you can contribute annually, definitely.
And then the growth policy within the insurance, I noticed it was like fluctuating 5-6% some years. Is there any guarantee on that, or is that just what the average is over the years?
Yeah, so there'll be two aspects to the growth of the policy. Aspect number one would be the guaranteed growth of the policy. So there will be a guaranteed rate, but that guaranteed rate will be lower than the 5% that we've quoted. The 5% really is based on what the dividend is currently. If we look historically, the rate has actually been higher than that. And depending on the insurance company, Canada Life, for example, they've been going for 150 years and they've had a positive dividend for all of those 150 years. So it's not guaranteed. The dividend is definitely not guaranteed, but we've seen a lot of stability. We've never seen a negative year in the dividends paid.
Sorry, can I go
Yes.
one more question? So I know James talked about obviously if you're investing in one of like a homes project is considered as an active business income. But what if let's say you have a few rental properties and you put it under the whole code, and of course that rental income would be considered active business income as well, I assume. But what if when you sell the rental property, if there's appreciation, is that also count as just capital gain, or that's count under active business income as well if there's appreciation?
Yeah, so I'd have to look at it's been a while since I looked at the rules, but generally, if you have real estate, let's say you put rental in, you need to have 5 employees, typically, to make it active. Otherwise, it's passive. I think that's it. Yeah.
Any other questions?
Anybody else dying for the mic?
I love hearing myself. No? Okay. So I will